Market structure and trading basics. Primary market. This is where companies sell their shares to people for the very first time. It's like when a bakery opens and sells its first cupcakes directly to customers. Secondary market. This is where people buy and sell shares from each other. It's like a used car lot where people trade cars they already own. Most of your buying and selling happens here. IPO stands for Initial Public Offering. This happens when a company decides to let regular people buy pieces of their business for the first time. They do this to get money to grow their company. Exchange. This is like a big marketplace where people meet to buy and sell stocks. The New York Stock Exchange and NASDAQ are the most famous ones in America. Stock. When you buy stock, you own a tiny piece of a company. If you buy Apple stock, you own a small part of Apple. Share. This is one piece of stock. If you buy 100 shares of Apple, you own 100 pieces of Apple stock. Ticker symbol. This is like a nickname for each company. Apple's nickname is AAPL and Tesla's is TSLA. It's easier to type than the full company name. Order types and pricing. Bid price. This is the most money someone is willing to pay for a stock right now. Ask price. This is the least amount of money someone is willing to sell their stock for right now. Bid-ask spread. This is the gap between what buyers want to pay and what sellers want to get. A small gap is good because it costs you less money to trade. Market order. This means buy or sell right now at whatever price is available. It's fast, but you might not get the exact price you want. Limit order. This means only buy or sell if the price reaches exactly what I want. You might wait longer, but you get your exact price. Stop loss order. This is like a safety net. You tell your broker, if my stock drops to this price, sell it automatically so I don't lose more money. Company valuation and metrics. Market cap. This tells you how much the whole company is worth. You get this number by taking the stock price and multiplying it by how many of shares exist. Public float. These are the shares that regular people like you can buy and sell. It doesn't include shares owned by the company's bosses. Outstanding shares. This is the total number of shares that exist for a company, including the ones that regular people can't buy. Earnings per share. This shows how much profit each share makes. If a company makes $100 and has 10 shares, each share makes $10. Dividend. This is when a company gives you money just for owning their stock. It's like getting paid rent for letting them use your money. DRIP stands for Dividend Reinvestment Plan. Instead of giving you cash, the company uses your dividend money to buy you more shares automatically. Market trends and sentiment. Bull market. This is when stock prices are going up. We call it bull because bulls attack by pushing their horns upward. Bear market. This is when stock prices are going down. We call it bear because bears attack by swiping their claws downward. Volatility. This means how much a stock price jumps around. High volatility is like a roller coaster, lots of ups and downs. Diversification. This means don't put all your eggs in one basket. Buy different types of stock, so if one goes down, others might go up. Trading positions and strategies. Long position. This means you buy a stock because you think it will go up in price. You want to buy low and sell high. Short position. This means you borrow someone else's stock, sell it, and hope the price goes down so you can buy it back cheaper. Going long. This is another way to say you're buying a stock because you think it will go up. Shorting. This is when you bet that a stock will go down. It's risky because if you're wrong, you could lose a lot of money. Short squeeze. This happens when a stock that many people bet would go down suddenly goes up fast. The people who bet wrong have to buy the stock quickly, which makes the price go up even more. Advanced trading concepts. Triple witching. This is a special day when 3 different types of contracts all end on the same day. It can make the stock market extra crazy that day. Green shoe option. This lets the people selling IPO shares sell extra shares if lots of people want to buy them. OTC stands for over the counter. This is when people trade stocks directly with each other instead of using the big exchanges. Dark pool. This is a secret place where big investors can buy and sell stocks without anyone else knowing what they're doing. Algorithmic trading. This is when computers buy and sell stocks automatically based on rules that people programmed into them. High frequency trading. This is when computers make thousands of trades in just 1 second. They're faster than any human could ever be. Market psychology and phenomena. FOMO stands for fear of missing out. This is when people buy stocks just because they see prices going up and don't want to miss out on making money. Panic selling. This is when people get scared and sell their stocks quickly, even when it's not a smart thing to do. Dead cat bounce. This is when a stock that's been going down suddenly goes up a little bit, but then keeps going down. It's like a dead cat bouncing once when you drop it. Pump and dump. This is when bad people lie to make a stock price go up, then sell their shares to make money while others lose money. This is illegal. Bag holder. This is someone who bought a stock, and now it's worth worth much less than what they paid for it. They're holding the bag of losses. Diamond hands. This means someone who holds onto their stocks even when prices are going crazy up and down. They don't sell no matter what. Paper hands. This means someone who sells their stocks quickly when they get scared. They can't handle the pressure. Financial statements and analysis. Balance sheet. This is like a snapshot that shows what a company owns, what it owes, and how much money shareholders have put in. Income statement. This shows how much money a company made and spent over a certain time period, like 3 months. Cash flow statement. This tracks how much actual cash money came into and went out of a company. PE ratio. This compares how much a stock costs to how much profit the company makes per share. It helps you see if a stock is expensive or cheap. Book value. This is what a company would be worth if you sold everything it owns and paid off all its debts. Investment approaches. Value investing. This is when you look for stocks that cost less than what you think they're really worth. It's like finding a $20 bill selling for $10. Growth investing. This is when you buy stocks in companies that are growing their profits faster than most other companies. Technical analysis. This is when you look at charts and patterns to try to guess which way a stock price will go next. Fundamental analysis. This is when you study everything about a company to decide if it's a good investment. You look at their money, their bosses, and their competition. Day trading. This is when you buy and sell stocks on the same day to try to make quick profits from small price changes. Swing trading. This is when you hold stocks for a few days or weeks to try to catch bigger price moves. Risk management. Risk tolerance. This is how much money you're okay with losing. Some people can handle big losses, others can't. Asset allocation. This is how you divide your money between different types of investments like stocks, bonds, and cash. Hedge. This is when you make one investment to protect yourself from losses in another investment. It's like insurance for your money. Leverage. This is when you borrow money to buy more stocks than you could afford with just your own money. It can make you more money, but also lose more money. Margin. This is money you borrow from your broker to buy stocks. You use the stocks you already own as a promise to pay back the loan. Margin call. This is when your broker says you owe us more money because your stocks went down in value. You have to put more money in your account or sell some stocks.